10-year note yields experience a pretty wide array of trade today. Early on, we saw yields dip below. We didn't quite get to 305, but we got very close to 305 as we saw sort of a flight to quality bid in the bond market, which started overnight and fed into the early part of the session. And then as things drifted on, we saw yields come back. We saw a trade back to the midpoint, sort of the range up near 310. And that's kind of where we sit right now. And the market right now has made a few moves towards that 305, which is going to become a pretty significant level. Recall earlier in the month that was the low. We never really got to 3%. Haven't traded 3% in the 10-year since mid-September, and that's going to kind of be the level that we look at. If we get through 305, you can probably see that momentum will take us, and those leveraged shorts that are out there, net shorts that are out there, leverage funds, they'll push the market, buying back those shorts. I think if we get to 3%, they'll be the momentum that takes us over the edge. We aren't there yet. But as you can see, there are cracks in the dam on days like today when there's news and headlines that push the market around. It is erring on the side of caution, and that pushes us towards lower yields. Right now, we're sort of past phase 1 or 2 or whatever phase we're in right now, but we certainly don't feel a risk that we're going to test 3.25 yield anytime soon. And not too long ago, that was where we were. So right now, yields trending and momentum kind of hanging us towards pushing down more buyers and more risk off type mentality. And if you look at market volatility, it does remain elevated in the Treasury sector. However, we did see a modest push of softening off today's highs. This morning, volatilities were high. We continue to push higher as we test those lower yields, but as we backed off, volatility backed off, market took a sigh of relief. Again, headlines had something to do with that. You have trade headlines come across that were more positive. You have maybe some more softer news out of Europe, and those are things that are going to continue to kind of give the market its fuel. And today it was just that. We pushed yields lower, and then late in the afternoon, late in the session, we sort of backed off. We're back to the midpoint of the range, hence volatility softened quite a bit. Lastly, let's look at some of those headlines. U.S. data aside, and we did even have Jerome Powell speaking last night about market volatility. Just one of those things we have to kind of accept. But Europe is starting to become more and more part of the puzzle. We heard from Brexit that they were trying. UK Prime Minister May was trying to sell it to her cabinet. In the wee hours here, early in the morning there, you had several secretaries resign. You had a vote of no confidence potentially coming up, and it seems like the mess that is Brexit, which started back in June of 2016. They've had 2 years to put this thing together, and we're coming now down to the final days and final hours. March 29th is D-Day. And they haven't been able to put together a package that will cleanly allow the UK to stand on its own while allowing trade and regulatory bodies to do their thing smoothly. And that is going to continue to be a problem and will continue to be something the markets are watching. And one of the main reasons I think today we saw the bid to treasuries. Likewise, we heard from our friends over in Italy, who now, with the budget issues they have with the EU, they don't want to change anything. In fact, one of their constituents has said they may even discuss leaving the European Union as well. That one's a little bit far-fetched. Yes, I know it hit the headlines, and yes, I know it did have a negative impact. Sort of that flight to quality bid again came through in treasuries. But when we look about the real issue here with Brexit, when you take a step back from the financial and the regulatory issues, it's the landlock they have with Southern Ireland, and that is kind of a very big deal. If you take that same landlocked scenario and look at Italy, it's going to have even a bigger deal. So right now, I think we're miles away from there. Yes, they do need to get their budget straightened out, and yes, they do need to find someone to buy their bonds. But ultimately, I think that they're going to try and figure it out one way or the other, whether it's just an eraser and a pencil play, or whether it is actually changing the way they spend and tax their people. So ultimately, Italy's probably more of a back burner story, but today it was something that we saw headlines of. Brexit remains the it story for Europe, at least moving forward till we get to March 29th. Here in the United States, we're talking about the U.S. data, which has come in very mixed. It's inflation, it's asset prices, and it's the Fed. The Fed right now is another hike coming next month. Next year, the market's priced for 2 hikes. However, the Fed's looking more towards 3 or 4 based on their dots. So there is a little bit of discrepancy there. Market and the Fed will have to come together at some point. Let's hope it's sooner than later. But right now, the market seems to be erring on the side of caution as 10-year note yields push to the lows, but back off towards the end of the session.